Hey everybody, it's me, Alex, over at Jet Lending, and today I have Eric with us. Tell everybody, say hello, Eric.
How's everyone doing today?
Oh, they're doing great, you know it. All right, so today our education is going to be refinances and how, like, the big buzz on the street is you'll hear like they used to call them non-QM, non-qualified mortgage loans. Uh, you'll hear them more as what's called DSCR loans, but what it really is, think of asset-based lending that you guys are always used to in the short term, but now in the long term. Okay, so think of hard money for 30 years. Okay, so easier ways to get things done, easier ways to hold properties and your entities and stuff like that, but faster than going to a bank, easier than going to a bank. So what we did today is we're going to go over a little bit of how these loans are structured. Okay, you might have noticed we've done a short term video on like how to negotiate um, with people to get lower prices on how you're buying them. And the importance of that is to know how your money works. And if you understand how your money works when you're getting lending, you know what you can structure. So these are refinances. Eric and I are going to do a one on how do you can purchase a straight 30-year. You can do cash outs and stuff like that. We're going to do one, but today's going to be about refinances. Okay, you're in a loan, but you need to refinance into a long-term loan. You're going to hold this for a short-term rental. You're going to hold this for just a rental, and you can't go to Fannie and Freddie products anymore. You want to hold this in an LLC, yeah, but you're trying to get things done. Okay, so. What do you think, Eric? Do you think we did you want to go? We kind of talked a little bit before this, and you wanted me to go up and kind of show them like going from short term to long term, some of that those equations before we get into some of the nuts and bolts, or what do you think?
Yeah, I think that would be beneficial for everyone to kind of understand, what your numbers will look like from coming from the short term or hard money side into the rental DSCR
Okay,
side.
cool. All right, so what we're gonna do here is we're gonna actually show you a deal. So, Eric, give me some numbers here. What are you seeing down the pipe? In fact, everybody else that's watching, if you actually have a deal and you want me to go through it, we can actually show you. But if it's so you can kind of just chat in the comments. Hell, you guys can network with each other. It's live, so feel free to comment in any kind of video form that you're watching. But since we don't have any numbers yet, I'll start going through these here. What do you think, Eric? Well, what do you see normally like a loan?
I have a
Uh,
scenario here if you want to use that one.
yeah, let's use that scenario.
Okay, so we can do purchase price 98,700.
98,700.
Mm-hmm.
Okay. Was there any repairs?
There was $20,000 in repair.
Okay. All right. What's the property valued?
The after repair value is 248,000.
248,000.
Yes.
Okay. What were the taxes,
478 with 20 cents.
For what was it?
478.
Oh, so a month. Okay. So
No, 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 that's the annual.
478 was the annual?
Yeah.
Wow. 20 cents. They got you on the 20 cents. All right. So let's say you did the short term. You first went to, you came to short term jet first. You get a loan to value loan. You got to fix this property up, do all that kind of stuff. So let's say put you at like 3%, at 11.9%, and we hold that 20 in escrow for your draws. Put you at a total loan of 173, and you were way $0 out of pocket on this deal. Okay, so we would actually lower this loan principal amount a lot because we can't go on we can cash out on a refi, but we can't cash out on a purchase. So for 45 grand, I put it 173 minus $45,000 puts it 128, and then 248 divided by 128 is 128 divided by 248. Isn't it exciting watching people do math in real time? Let's do 52% loan to value. There you go. You're still $0. You're still $0 out of pocket. This is a real deal. This person is still $0 out of pocket at 52% loan to value. We could have went up to 70, but they didn't need it. They're still zero. That's nice.
Yeah, that is pretty nice.
So go to my DSCR and let's see. Uh, let's use 20% vacancy and maintenance for their net profit calculations. What was the rent?
Right now, the market rent we have is 1,700.
Wow, 1,700. Loan to value on the refi,
They're looking for 70%.
70%.
Yes.
What's the interest rate today?
The rate that I have right now for this client is 7.625.
All right, it was 30-year loan.
This is a 30-year fixed loan.
Okay. All right. So right now, what I'm looking at, the DSCR hits the 1.1, so because it's 1.03, and right now they're looking pretty good. Like
I
so,
think.
what's up?
Um, Let me see. Do we have the loan amount in here?
Oh, I actually, you know what? I still had $3,000 for flood insurance. Let me take that out.
Okay.
So 1.22. I'm sorry, that's my fault. That's even better.
Okay. Yeah. Okay. I was just wanting to make sure. And let's see. I'm just looking at your numbers just to make sure that everything catches on.
Now
Insurance, I have 1073.76.
1073.76.
Yes.
All right, so let me do that. 1073.76. There you go. I just went down from a 1.22 to 1.21. Okay. And we're going to go through this. And so this person, go ahead, Eric, anything?
No, I'm just comparing the numbers, just making sure that everything's accurate and everything looks good.
So this person has after the refinance, they closed and came $0 out of pocket on their second closing. Okay. They cash flow about $291 a month. They have about a 10.5% return cash on cash. And this is the exciting part. This is why I don't want people keep talking about, well, the interest rates are going up. This is your wealth right here. Okay. Equity growth over 30 years, $669,000. Cash flow over 30 years. I mean, most of you guys aren't even going to keep this for 30 years, but if you did, $105,000. Estimated profit within 30 years is 1 million and change.
Wow.
And that is what you do with rental real estate. Holding real estate is wealth. So no matter what the rate changes, you still need to buy inventory, okay? Because these rates are going to go down. My projection on this is you're going to see even though I think it's going to be a forced decrease, I think you're going to see the spring of 24 rates going to go down. I think you're going to see like 4.5 to 5% rates in the spring of 24. So, I mean, you should still be buying these things like hotcakes and knowing that you're going to be even a better place because you're going to have another year or two of appreciation before you could even refi again if you wanted to.
Oh yeah, this is the perfect time for investors to be picking up properties, especially for rentals.
Yeah, so I mean, so Eric, now that we the audience almost has a glazed look over their eyes, but seeing math, in real time, that's what your loans look like. But let's go over, what are some of the things you wish borrowers knew when they're getting into these loans? Like what are some of the pitfalls that they got to be aware of?
I think one of the biggest things is knowing the numbers for your property. Knowing what knowing the market that you're currently in. Um, if you're going to be shopping around in the Houston area, whatever neighborhood or whatever area you're looking at, you want to make sure that you're looking at the comps, right? You want to make sure that the value is going to be there once you do the repairs, if you're going to be making any repairs, and then two, um, you want to be realistic with the loan amount and the amount that you want to get back. Right now, during the market, during current situation that we're in, or the current market, um, rates, of course, you've seen that they've increased tremendously. Today we had an update. Of course, they were dropped a little bit, but um, making sure that there's going to be affordability, making sure that the DSCR, the main thing is that service cover ratio for these rental loans. You want to make sure that it's going to be in the positive. That's going to be two and up, depending on the type of program that we're offering. But you want to make sure that every month you're going to be profitable. You want to make sure that you do your due diligence, checking the market rent within that area, because you don't want to go into an area where all the rents are ranging 1,500, but you're expecting to increase the value to 500,000 in that area, and you're looking at 4,000, $5,000 in rent. It's not going to happen.
Right.
So you have to be realistic, and you have to do your research on that area and that market, that property, that rental, or if it's a long-term rental or if it's a short-term rental, depending on where it is, you want to make sure that you do all that research.
Yeah, especially in Texas. That's why we comp
Hmm.
so heavy. Sometimes we give you the borrower, not what they want to hear, but it's what it is.
Yeah.
Listen, before you buy an appraisal and before you do this, you need to be aware of this. Are you aware of all this? So you can be profitable. Because if you're not profitable, we can't, one, probably can't close the loan. Two, you can't buy anything else. And if
Yeah.
you're not buying anything else, we're not making any more money. If you're not buying anything else, you're not making any more money. Remember, this has to be both parties win. You got to be making money, and so do we.
One thing I like that you touched on is talking about the appraisal. One thing that I've seen is or stuff that gets advertised, right? You always want to close quickly. You always want to, during the hard money, you want to jump on those deals to be able to get that deal before somebody else steals it from you, right? But you always want to, like I said, do you want to do your due diligence? You want to see what that property is worth. And that's one of the things that we do, right? We do whenever we're doing our hard money loans. If they're going to be holding it for rent, we're going to look at what their as is value is, current value, what their after repair value will be subject to those repairs, and then what the current market is showing for your market rent. So that way our clients know what they're getting into, and that way as they're fixing the property up, they can make those determinations. Do they want to keep the property? Is it going to be, is it going to be beneficial? Is the market increasing or is the market decreasing? Because at that point there, when you have that property and you're doing those renovations, you'll be able to make your decision on which route you want to take. And you always want to get an appraisal because you want to know what your property's worth.
Right.
Why would you want to spend thousands, hundreds of thousands of dollars on a property that that they want to close quickly, and you don't get an appraisal, and then you come back and you find those hidden surprises when you're trying to do
Right.
the rental stuff, which in turn will come back and delay our process. you
Right.
know that's one thing that will delay our process.
Well, speaking of, I mean, what's one of the things that we can talk about on these DSCR loans? What does delay the process mostly in when you see like five or six things that you wish borrowers would know, whether they're using jet lending or not.
Hmm.
But like what delays, because one thing's when people think that oh well, let's say we work at Jet. What you guys are going to close in 7 days, right? Or short term, but or long term, all these monies are secured by Wall Street entities. There's
Yes.
other guidelines and stuff, and they're watching the Fed and all these other securitized institutions. So there's a lot of they close way quicker than a bank, but it's not in you know 3 days.
Correct.
So what holds you up? What do you think bars would know about this process that they're so used to using the short term side with lenders? What about the long term side? What do they need to know?
So one of the things that holds us up, I know, especially with the appraisals, is one, when the borrower doesn't get an appraisal to begin with. They bought the property, they either paid for it cash, or the lender that they went to didn't require an appraisal in order for them to close, so they really didn't know the value that was there, right? Now we do the appraisal. They bought the property for, say, 300,000. We do the appraisal and it comes back at 350 after repairs. You know, that's one of those things that you want to make sure. You want to make sure that your numbers are going to be legit. You want to make sure that the value is going to be there, especially if you're going to be spending all that money. You
Mhm.
know, um, Another thing that holds us up is liens. Is the client sometimes not giving us all the data in the beginning? Not letting us know, hey, aside from paying off this loan, I do have two, three additional liens that need to be paid off on this. How can we structure that loan so that way all of this can get paid off? You know, um, One other thing that I would say is the amount that you collect during your hard money. Okay.
Mhm.
Looking at those numbers carefully, everyone wants to come out zero out of pocket, right? Everyone want, if that's an option for every single loan that you do, amazing, because you're coming out with zero out of pocket. You're not having to touch your money. However, if if the value is not going to increase significantly, your after repair value is not going to increase significantly, and you're already at say 70, 75% of the ARV, now you're limiting yourself when you're going to be refinancing, because refinance LTVs right now for cash outs can range anywhere between 70 to 75 maximum. You
Right.
know, rate and term even got dropped. So right now, where last week we were able to do rate and terms at 80% loan to value to kind of roll in everything in for that borrower. Now we're capped at 75%. So if you're tapping into 75% of that ARV and you didn't increase the value enough for that property, then you're not going to get that return. You're going to be coming out with even more money out of pocket.
Right. I mean, so especially when people analyze your deal, and let's say
Mhm.
they give you 75% ARV, and they know that 20 grand ain't 20 grand's fantastic for rent ready,
Mhm.
neat. But you're pulling comps that somebody did like more like 50, $60,000 worth of
Yeah,
repairs. And so your ARV on appraisal is not going to contend with those comps.
exactly.
So one, your value's down, so you have to lend 75% of that value. Or two, it comes straight out. Like you thought it was worth 350, it appraises for 350. Your short-term lenders lends you 75% of value. And now you're trying to refinance. Well, you're going to have closing costs, and you're going to be out of pocket with on your second closing. You got title fees, you got lender fees, and all these other things that are going to be a part of that second closing. So you have to have some liquidity ready to go when you're a landlord, or you're just starting out to be a landlord. You haven't done one yet, and it's your first rental property. Make sure you have some liquidity set aside for that second closing, because you may be out of pocket that second closing, um, even though you weren't out of pocket your first closing.
Correct. Yeah, and staying within budget as well. Sometimes, and of course, right now with prices going up on everything, it's going to be hard to stay within budget, right? But you want to try and stay within the budget, and if you're going to be adding square footage, at the square footage. If that's what you're proposing to that appraiser when you're doing that hard money, and you're saying, hey, I'm going to add 500 square feet, they're basing that subject to value based on the 500 feet that you're going to add,
Mhm.
right? So then when you come back to us and you say, hey, I'm ready to refinance, but all you added was 200 square feet, then that value is going to decrease because you're missing out on the additional 300 feet that you told us initially that you were going to add. So then your value is not going to be there. And now that's where, sometimes we'll get borrowers where that's where we're having to go back and kind of revise or review that original appraisal and where those numbers were, and where the differences were in both appraisals. Why were the numbers different? So we want to make sure that we get to the bottom of it as well, because if it's a mistake on our appraiser side, we want to get that corrected for them.
No, I agree. And one of the things I always mention to people is, because these are securitized lines. Basically, what that means for you guys listening is, these institutions allow us to refinance these loans. They package those notes up and sell them as like blocks of securities. Okay. Well, with ever changing financial market, as you guys have seen, all of those securities always change conditions and things needed and things like that all the time. So whoever you're using, hopefully you use us, but whoever you're using, you got to be just Johnny on the spot with a lot of things. Because all of a sudden you'll be asked for something that you're like, why wouldn't you just ask for this for me like a week ago? You're like, I didn't need it a week ago. So this is a team effort. You guys are working together, getting things that you need. As the borrower, get them to us as fast as possible so we can clear everything. Because it doesn't do us any good. We don't make any money unless we close the loan. You got to remember that. So if we're asking for it, trust me, we need it. We want it, we would ask for it earlier if we knew. So just be patient and work as a good team to get everything that you need to get done. Okay.
And I think on our side, right, I mean, a lot of our document requirements, because we're on the non-QM side or the DSCR side of the mortgage world, we're not looking at the borrower's personal financials, right? The documents that we ask for are documents pertaining specifically to that property on how you're going to be able, we're looking at liquidity and we're looking at who the ownership's going to be. And if you have income coming into the property as far as rent, that's the other thing that we're looking at. And we're making sure that you have a clear title. Those are the only things that we're looking at on the loan and the type of documents that we add. Now, if there's things that pop up under the credit, if there's stuff that pops up under background checks,
Mhm.
you know, those things will delay us as well.
Yeah,
Because now we're having to do the research and seeing if those type of charges are allowed for the loans, because there are certain type of charges, that we're not able to perform loans on, like theft, forgery, you know, where it'll be very difficult and very hard for our underwriter to give us an exception to proceed with that.
right. So just let people know everything, the whole story up front, and
The more we know, the more we know, the less that we're going to be asking.
yeah,
Right?
yeah. I mean, so and another thing that you guys have to consider in this market, because a lot of you guys, again, the rate, some people is scaring them. They're like, well, like, I think there's going to be, a decrease in value in properties, and that's what I'm going to buy. Let me be the bearer of bad news. I know this is my opinion, but it's a big opinion. Okay, values aren't going down. All right. There's not going to be this overwhelming foreclosure thing that you saw in 2008. It's not the same thing that's happening. So you got to know that about it was 65% of all loans right now are under 4%. 80% of loans right now, mortgages, are under 5%. Those people are not selling their house. Most people are like, yeah, I'd like to have a new house, but I'm going to wait. Okay. What does that mean for you as the investor? Rent. When people don't buy, they rent. Okay. This is a very unique opportunity for you as an investor to get on these loans and to buy this inventory, because rents are going to go up. And it's going to be a very, very profitable acquisition for people that are doing hold real estate. So that's why you're seeing listings going down, but you're not seeing people buy 30% above market anymore. But
Mm-hmm.
the values of properties aren't going down. We're still at 2.7 months of inventory, which at Jet Lending, we still feel that 3 months is a balanced market. We don't believe the 6 month, where a lot of the national economists say. We feel that's more of a buyer's market. But an equal market's about 3. We're about 2.7 now. So you're probably starting to see a little bit easier buying times right now. But this candidate person's opinion is, you're not going to see a decrease in value. You're not going to see a bunch of foreclosures. You're not going to see a huge drop in rate probably till spring of 24. You should still be buying. And it's not because, remember, if these things go bad, we end up with them. We don't want them. Okay. We as a lender, we only make money when we lend. We get frowned upon when things go bad. And we're still telling you should be buying. Okay. So, Eric, do you have any other last words of wisdom for everybody before we meet them again and go over a different topic?
No, I think if anything, I mean, if anyone has any questions or you want to reach out to anyone on our team, just Alex, I guess you're going to be putting our information. Yep, there you go. You beat me to it.
You can call Eric, you can text him, you can email him. Hell, he'll accept a carrier pigeon. You can do whatever you like, and he'll get with you and discuss your business plans on what he can do with his products. Well, Eric, thanks for taking the time out and telling and educating everybody on how to refinance using asset-based lending. And if you'd like to get with Eric, it's eric@jetlending.com. You can see here on the bottom, you can comment on this at any social media platform you're doing. Eric will get with you. You can text him at that number right there at the bottom. We hope we can help you out. We hope this was educational, informative, and We'll see you again tomorrow.
See you tomorrow.